the finance in specific to agriculture. So there are a lot of reasons to study about the agricultural finance. For example, if we need to get a yield, so there are different inputs and different labors and different kind of things are involved in it. So this kind of things will not happen without money, right? So, for example, inputs like land, machineries, tools, fertilizers, seeds, inputs. So, each and every input should be bought at a cost. So, of course, the agricultural finance is very much essential to study in upcoming days. Okay, so let's see about the importance of agriculture finance in general. For example, if you take any sector or any region or any group of peoples, for example, if there is a low investment, the capital will be deficient. So if you have a low investment in a particular sector or a particular firm or a particular industry, the capital will be less. If example, for example, if there are 10 peoples who have jointly started in a firm and they have invested around 1 lakh, and similarly the same setup started by another group, they have invested more than crores, so there will be a capital deficiency in the first group, so which will automatically lead to low productivity. So low productivity which will lead to low income. So low income in the sense, if the product is not good, you will not be buying in the market, so the demand will automatically be low demand, so the demand will be less. So based on this, the income will be less, and the low investment will be there. So this is a vicious circle of poverty. So if you got into this trap, you will be in a poverty level. So to overcome this, there are a huge investment is needed. If you have a huge investment, the capital will be high. New technologies, new methods can be adopted for production, and you will have new products which will lead to higher income, which will lead to a higher demand. So to come out of the poverty, you need to follow the circle, and you need to check out this circle. And another important thing is, with the increased population, so we cannot extend our land area available. There are contradictions, and the land area put under agriculture is reducing nowadays. So we need to intensify and we need to diversify our crop. So for that, we are in need of huge capital. Huge capital in the sense, high diversification. We need a large number of high yielding varieties and new improved technologies, and how to adopt within an area, within a single acre, how we can multiply our yield. So those kind of things need to be considered. And the second one is, more than 74.5% of farmers in India have small landholdings. In this case, the small landholdings are, we can classify the landholdings into 2.5 acres per farm. So if a farmer has less than 2.5 acres, he is considered to be in a marginal, low, high, and medium. So based on that, 74.5% of farmers in India have very small landholdings. So with the small landholdings, they cannot either involve in adoption of high technologies, or they cannot use high yielding varieties, machineries like that. So there are different constraints, and followed by that, there is another thing called, which is the major issue for us, is uncertainty. Uncertainty in the case, either it may be flood, drought, famine. So these are the factors which affect our farming. So this is another case, and followed by that is increasing irrigated area. So when compared to 2000 or 1950s, now the irrigated area under agriculture has been increased. So with the increase in irrigation, there is a huge need or a demand for fertilizers, plant protection chemicals. This should be used in more. So if we need to buy more amount of fertilizers and plant protection chemicals like herbicides, weedicides, etc., we are in need of money. So this is one of the case, and so huge capital investment is needed. So these are all the factors which are all the factors which influence, or which are the factors which have the importance for studying the agricultural finance. So let's get back into the history, how the finance has started in our India. So until 1935, so I will tell what is the reason for indicating the year 1935. So until 1935, there were no lending institutions or any of in 1900s there were cooperative societies, but after 1934 there is a large structural break has happened. So until 1935 there were only the landlords who were able to lend, or who were able to provide money to the farmers. So what is it? There is only one person like landlords. There will be a limited number of landlords, and the demand for money is very high, because the landlords will only have the money, and the poor farmers, they cannot afford for buying a seed or a fertilizer, or not like that. So they are relied on landlords. So they have a higher interest rate for the money. So for getting a single rupee, they occurred around 1.5 percentage of interest rate, higher interest rate. So these are all the factors which involved in the creating of financial institutions in our country. So we will discuss this about the introductions of cooperative societies and everything in later slides. But now, as of now, you just think of this history, what happened in 1935 and what is the situation happened then. So credit. What does mean by credit? So it is derived from the Latin word, which means that credo, which means I believe. So the credit, which is nothing but the money which is provided to buy some certain to some. If, for example, I like to buy I like to buy some iPhone, and I don't have a huge amount to buy the iPhone, but I'm more satisfied, or I need to buy the iPhone. So what I will be doing is I will be lending some amount from my friends. So the money which is provided to buy certain commodities at an interest rate which can be repaid soon or later. So this is the simple definition you can have. And the credit which was given, the definition which was given by Galbraith was the temporary transfer of purchasing power from those who have surplus to those who are in need. For the similar example, who have the surplus money, they can lend to the poor peoples and the needy peoples based on some interest rates or something else. So this is the simple definition given by Galbraith, and followed by that there are several other definitions which was given by several economists, and obtaining the control over the use of money at the present time in exchange or promise to repay it in some future time. So these all definitions which has a single meaning that we are in need of getting a money at some interest rate, and we will be repaying it at later stage. So this is given by different peoples at using different terms. So that's it. And the followed by that is agricultural credit. So what is it? So we have learned about the credit. So what is agricultural credit? So the agricultural credit is nothing but it is we know that from the name itself we can see the credit which is used for the agriculture purposes. So the investment which are made for agricultural production outside the farm sector from the resources. So next one is agricultural finance. So what is the difference between the credit and the finance? Agriculture finance is the field of study which deals with the lending and borrowing operations which are done by the organizations or either the persons, between the persons. So these are all studied under the agricultural finance. So and again Hopkins, he has defined as a means of acquiring and control of assets, ownership by cash purchase or borrowing and leasing. This is the definition given for credit. And followed by that, William G. Murray was given an definition for finance, which is nothing but the study of borrowing of funds or income or some money by the farmers or the person of the organization on operation of farm lending agencies and societies' interest in credit of agriculture. So I hope you have some idea about the credit, finance, and everything. So now we can classify the credit into different classifications like purpose. Based on purpose, we can classify the credit and repayment period, security, liquidity, the lender or the creditor classifications, approaches, contact. So let's see one by one. The first one is the purpose. So what is the purpose? Okay, let's see. The production. So based on the production, we are in need of credit. For example, we will take farming as our main occupation. So for for doing farm activities. I am in need of money. If I have money, I can go and I can use the money for buying some inputs, and I can harvest the paddy and I can use for the next season. But if I don't have money, I have to take some credit from the either from the lending institutions or from the traders or from the farmers or the neighbors. So based on the production, the credit is classified, and this credit is given to the farmers mainly for the production purposes. So it is also called as the seasonal agricultural operation. So the repayment period and everything takes place within 6 to 18 months. What is that 6 to 18 months? Is that the season of a crop? For example, if you take rice, the season would be around either or 2.5 months or 3 months, like that. So based on the seasons, the repayment period will be fixed. So this is under a production loan. And second one is the investment loan. So investment loan in the sense that we are going to invest in some firm or some sector, and we are going to it definitely it is in a durable asset. It is acquiring of asset. So, for example, purchase of land, farm machineries, irrigation facilities like motors and every other things. So, these and all comes under the category of investment loans. So, the production loan, we will be dealing only with the crop production, which is called as crop loan, which is also called as crop loan. So, the month is 6 to 18 months. But in case of investment loan, we are buying land or some farm machineries and irrigations. So, the duration will be larger. And the third one is the marketing loan. So the marketing loan, in the sense, it is widely adopted because you can see the distress sale, because the farmer will be in need of cash after the harvest. So he will be selling at what the price it comes of. So there are different organizations like cooperatives, regulated markets, and commercial banks, which provide a warehouse receipt. Warehouse receipt in the sense, there will be the warehouses or cold storage units or the storage units which be available in taluks or in districts. So where the farmers can place their produce after the harvest. They can place their commodity there, and they can have the ware receipt. I have shown here. You can see the ware receipt. So there the farmer details and what commodity it has been stored there and how much value it can be. These all will be filled, and based on the value of the produce, 75% of the income will be given to the farmers. So this kind of things comes under the marketing loan. And followed by that is consumption loan. So consumption loan, as the name says, you can understand, other than the production, what are all the loans you have for your consumption, it comes under consumption loan, and it is not widely advised or used because it cannot be, and it is restricted only to regions where the natural calamities and there are a drought and some natural calamities which happen there. So based on that, the consumption loan will be taken up, and the repayment period will be within the 5 crop seasons. And second one is, so far we have seen 4 types of loans which comes under the category of purpose. And now we will be discussing about the repayment period. So based on the repayment period, there are different kind of loans which are provided. So first one is the short-term loan. So as I said earlier, crop loan, seasonal agricultural operation loan. So this is same. So the crop loan, to meet the expenses on the ongoing agricultural activities. For example, if the farmer are in need of buying seeds or fertilizers or herbicide, so he can use the short-term loan. So he can acquire from the lending agencies and he can repay. So the repayment period will be 6 to 18 months within a crop season or 2 or 3 crop season. He has to repay the amount. And the second one is medium-term loan. So medium-term loan in the sense, for example, the investment loan, which I said in the purpose loan. So the medium-term loan will be purchase of farm implements, dairy animals like cattle, buffaloes, and all those things, and minor improvements in farm activities like irrigation facilities or buying of new motors or submersible motors for irrigation facilities. So these comes under the medium-term loan. So the duration to repayment of the loans will be around 18 months to 5 years. I think many of the exams, when I was writing the exams, I came up with the questions like the duration of the short-term loan, medium-term loan, like that. So you please do consider this as important. And followed by that is long-term loan. So as the name indicates, for example, farm buildings or tractors or establishing an orchard. Because in case of orchard, you cannot get the income from the first year itself. So you need an break or a growth period. So, for example, if you have an orchard, mango orchard, it takes around 2 years or 3 years in case of high density planting, and in case of the improved seed varieties. If you are following a traditional one, it may take around 7 years. So this time will be a zero income level, zero income period. So this kind of things will come under the long term loan. So the activities which requires a huge capital, and the repayment period will be greater than medium term loans, which is around 5 years to more than 10 years, and even more. It happens. And this is the second one, based on repayment period. And the third one is security. So security, in the sense, there are different securities. For example, secured loan. So secured loan, in the sense, the loan are advanced to borrower based on some securities. And the other one is the unsecured loans. What is mean by unsecured loan? Because it is widely used. It is common in village sites, or in even in rural and urban areas. Like based on the confidence between two persons, they will borrow and lend. So there will not be any securities which will be made among them. So this kind of things is unsecured loan. So we will see the secured loan. So the secured loans, first classification is personal security. So if I need a loan and I don't have any securities, I can have a promissory note, and in the promissory note I can the deed, like for example, if I am in need of 20 lakhs and I will repay the 20 lakhs in around 1 month or 1 year at a rate of interest. So these things will be written in the promissory note, and it will be kept. So either it may involve the third party, and it will be between the borrower and the lenders. So based upon them, the personal securities will be provided, the loans will be provided. And the second one is collateral security. So here, and again, the collateral security is it is based on the properties, which are the movable properties. So based on the movable properties, the loan will be acquired. So like LIC bonds, fixed deposits, or warehouse receipts. So this will be used for the collateral securities. And the third one is chattel loans. So chattel loans, so you can see this is widely or common in Tamil Nadu, I think so. The pawn brokers, where the peoples will keep their jewelries and other things, and they get the loans, which comes under the category of chattel loans. And this is the promissory note. Here you can see the amount of rupees. Some 20,000 is borrowed, and at the interest rate, and everything will be given. So based on this is an example for promissory note in case of personal security. And this is the LIC bonds. Based on this LIC bond, the person can keep this bond in the lending agency, and they can buy the amount or the loan from the borrower, from the lender. So the next one is, sorry for the inconvenience, and the next one is the mortgage loan. So mortgage loan, in the sense, it is based on the immovable properties, like house, which is kept as the security, and based on this, mortgage loans are done. One fine example is that some of the government officials, they may get the house loan based on the mortgage. So what they will do is that they will register their house in the name of the lending institution in the registrar office, and they will provide that document in the bank for acquiring their loan. So this is kind of a mortgage loan. So this is the activity which are nowadays taking peak. And the mortgage, the borrower is called as the mortgager, and the lender or the banker who is called as the mortgage. So this also, and in this, the mortgage, chattel loan, collateral loan, you may get confused some of the times, because these kind of questions are also asked in some of the examinations. And in the mortgage loan, there are two kinds. First one is the simple mortgage. So simple mortgage, in the sense, for example, if I have a property which is my ancestral property and I don't have any right on that, of course I have the right, but it is not in the name of my own self. So and again, I need to buy some loan from the bank. So what I will be doing is, I will be registering the property in the name of bank, and I will get a loan. So the next one is the equitable mortgage, which is that if the property is in the name of myself and I don't need to change or register in the name of bank. So which kind of that kind of things happens in that equitable mortgage. And the next, so this is the mortgage deed. What will be there is that so the if for example I'm having a loan which is worth of 25 lakhs, and I need an loan on the same housing loan if I'm making for housing loan. So what we'll be doing that is that banking institution will check my house value, and based on that they will the percentage based on that percentage of amount will be given as loan for me. So what I will be doing is I will be either registering the house in the name of a lending institution, and I will submit those documents to the bank and I will get the loan. So this is the deeds which will be similar to this nowadays. And this next one is the hypothecated loan. So it is similar to that of mortgage loans, but in this case, the ownership of the either the ownership will be with the borrower, and the banking or the lending institution, they can have the property either in case of defaults. Defaults in the sense if we are not able to repay the loan, in that cases the bankers they can have the ownership of the movable property or anything which we got. So this is the hypothecated loan, and the borrower is called as the hypothecator, and the banker or the lender is called as the hypothecated. And the best example which I can give is the bike insurance, bike loan or car loan. So if you get the if you buy a car based on some what we say in Tamil. Sorry, one sec. Okay. So if you get the finance from some financial institutions, and after that you buy a car. So if you are unable to repay the EMIs every month, in that case, if you are a defaulter, at that time the bankers or the financial institutions, they can take over the ownership of the either the bike or the car. So this kind of things happens in this hypothecated loan. And in this there are two different types. One is the key loan. So key loan is as I said earlier, to avoid the distress sale. Based on the warehouse's receipt or some other things, they can avail the loan. For example, if the farmer wants a key loan, they will keep the the warehouse receipt. So he can buy the warehouse receipt from the regulated market, and he can submit the warehouse receipt in the bank, and he can acquire some loan from the banks. So these kind of things happen in the key loan. And the other one is open loan. Open loan in the sense that for example, one example is that tractors. So if the farmer is willing to buy a tractor, the ownership, the physical position will be with the farmer, and the legal ownership will be with the bank. If he is unable to repay the rest of the money, the bank has the power or the right to take back the property from the farmer. So so that kind of things happen in kind of a open loan. And next one is lender classification. So based on the lender classification, institutional arrangements or institutional loans. For example, there are different banks like cooperative loans, commercial bank loans. So these banks comes under the institutional arrangements, and the non-institutionals are like money lenders, traders, relatives, friends. For example, I will discuss briefly in upcoming lectures, but anyway, I will just give you a glimpse on that. The farmers who are who will not be going to bank and have the loans, because they will be going to the traders or the mandis. So the mandis who have the middlemen, the merchant middlemen, so they will be they will be having more power on farmers, because in the next period, if they need a certain amount, they will be going directly to the mandis or to the traders. They will not be going for the banks. That is the condition which is happening or prevailing in Tamil Nadu, especially. And the other type of lending is liquidity. liquidity in the sense self liquidity loans. For example, crop loan. So if you get a loan and the based on some purpose, if you get a loan based on the purpose, and if the income is generated within a year after getting the loan for that particular matter, so the crop loan, for example, crop loan, it should be paid within a year or two or three crop seasons. So which is called as the self liquidity loans. And the partial liquidity loans, the next one is partial liquidity loans, which is nothing but it takes time to generate income from the activities which we for which we have got a loan. For example, machineries or orchards or some other things which takes a huge capital. And the next one is approach. So based on the approach, the income is sorry, the loans are provided. Either the first one is the individual approach. So individual approach in the sense it is based on a particular person, based on his purpose or based on his thing. The loans are provided. And the second one is area approach. So area approach, it is widely used in case of insurance, but any of the loans are also provided in this case, area approach. So it is mainly based on the drought prone areas. For example, if particular district or particular taluk is being under a drought for a longer period, so the farmers can get the loan based on this area based approach. And the third one is, which is main important, is differential interest rate. So it is provided mainly for the weaker sections who are very poor, and they can avail the loan at a interest rate of 4% per annum. So this is also an important one, because it is also asked in some of the exams. And the final one is the contact, based on the contact. So if you are direct contact and indirect contact, for example, directly to the farmers, and indirect means money lenders, traders, relative friends. So this is the